Well, good morning, Jagendra Rana here. The topic for our discussion today is early death of life insurance policies. Early death of life insurance policies. Insurance is a long term business in which customers and the industry benefits if the policies are held for long. But given the poor persistency performance, huge cost and fat commissions, customers haven't benefited in a meaningful way, while insurers and distributors have. The Indian life insurance industry continues to manufacture and sell products that die early. So the life insurance industry was able to retain an average of 65% of its policies after the first year and 34% after the 55th policy year. So this means that 1 in 3 policies sold don't survive 5 years. These numbers compare poorly with the global average. While life policies retain close to 90% of their customers after a year of sale and about 65% after 5 years. So in insurance parlance, policy retention is known as persistency, and persistency ratio measures how long customers stay with their policies by looking at the number of policies renewal year after year. So the number don't bode well, as life insurance is in the business of selling long-term products of 10 years or more, and so it benefits if customers renew their policies year after year. Poor persistency does not just hurt the insurer. You as a customer stand to lose much more, largely because of the way life insurance policies are designed. So tracking persistency is therefore important, but the way persistency ratios are disclosed at present is not precise enough to give a true picture. So life insurance is a long-term contract, and the costs are built keeping in this in mind. Cost of a 15 or 20 years product are front loaded on the assumption that the policyholder will stay the course for the full term of the policy. However, the latest persistency numbers released by the insurance regulator point out that the industry on an average is unable to retain even a third of its customers at the end of 5 years of a policy. So excessive delay in payments and servicing of the policy leads to the policy being dead or lapsed. However, a left policy may be revived by fulfilling the terms and conditions as per the policy statement. So to avoid losses to all parties, generally the revival and reinstatement is encouraged and facilitated. The combination of economic slowdown and mis-selling of policies has hit the Indian insurance industry where it hurts the most. One of the reasons behind the high lapse ratio is the slowdown that gripped India. So reeling under financial stress, many policyholders chose not to renew their policies. But experts also blame rampant mis-selling by some private insurers. Many policies were sold without adequately explaining features to policyholders, leading to non-renewal of policies. Almost the entire industry has lower than 50% persistency in the 61st month. This means that half the policyholders left within 5 years. Internationally, this is over 65% on an average. So early collapse of life insurance plans Even as persistence is important for insurers to make money, heavy penalties on early exits and lapse ensures that they still made money. It's the policyholder who loses money invested. So persistency numbers are still improving but are still far below global average of 90% after 1 year and 65% after 5 years. Although still a long way to go, persistency numbers are improving slowly. The average persistence ratio is 61%. So this number should improve. For the purpose, because the increase in ticket size by selling policies to more affluent customer segment is perhaps the main reason behind improvement in the persistency. So in the case of persistency, new ULIPs, where most customers continue to pay premium even after 5 years lock-in period, is the main reason. But the industry has a long journey ahead. As actuarial experts say, persistency of less than 80% can impact profitability over the long run. Since fixed cost gets spread over a smaller base, so keeping the expense ratio high, changing products and distribution can bring about improvement faster. Persistency will improve it if traditional plans undergo from similar to unit-linked insurance, or if a higher proportion of products is sold through direct channels like the online medium. So systematic changes like training agents to sell in a need-based manner takes place relatively slowly. Life insurance is a long-term contract and the costs are built keeping this in mind. The cost of 15 or 20 products are front-loaded on the assumption that the policyholders will stay the course for the full term of the policy. However, the latest persistency numbers released by the insurance regulator point out that the industry on an average is unable to retain even a third of its customers at the end of 5 years of a policy. So whose money is lost? Poor persistency is largely reflective of the hygiene standards of the industry. But insurers also hold the way life insurance products are constructed responsible. ULIPs that were sold 6 years ago had a feature that allowed policyholders to exit after 3 years, and most of these did not have surrender penalties after the 5th year. This led to customers prematurely closing these policies rather than staying longer with them. LIC, however, feels consumer behavior is responsible. Some of the factors that can be attributed to low persistency are unexpected change in the policyholders' financial position, uncertainty in job market, and failure to pay premium on time. Some policies have auto cover facility and policyholders have the option to pay premiums as per their convenience. But this is not reflected in persistency ratios. Even as persistency is important for insurers to make money, heavy penalties on early exit and lapse ensures that they still made money. It's the policyholder who loses money invested. IRDA stepped in to cap surrender penalties in ULIPs, which is what the industry was selling in the first year to 2000. In the fourth year selling till then, the cap is maximum of 6,000 in the first year, to ₹2,000 in the fourth year, and nil thereafter. So the industry moved to selling traditional plans, prompting the regulator to review these as well. But even under the new regulations, traditional plans continues to have high exit charges in the initial years. So you lose money if you quit a traditional plan midway. How long customers stay with their policies is determined by the persistency ratio, which indicates the number of policies that continue to generate annual premium that are due to be paid. Almost the entire industry has lower than 50% persistency in 61st month. This means that half the policyholders left with 5 years internationally. This is over 65% on an average. So currently, the 5 insurers from a total of 24 have a part of 70% persistency ratio. 18 have improved their numbers. So most of what the insurance industry sells now is traditional plans, which have high exit penalties, 100% of the premium in the first couple of years. So when you decide to opt out of a policy, you actually end up foregoing your premiums. Because the persistency means that you are losing money by way of exit penalties. To give you an idea of the magnitude of loss to customers, here are some rough calculations. The industry sold, say, 26.4 million policies given an average in FY17. So given an average persistency rate of 65% after a year of sale, only 17.2 million policies were renewed. This means 9.26 million policies dropped out. And since the industry is dominated by traditional policies, it means that a large part of these policies did not give any money back to the customers. So persistency has not shown a marked improvement, and if the insurers are not able to retain even 50% of their customers after 5 years, then the products being sold are really not long-term products. Some policies have auto cover facilities, and policyholders have the option to pay premiums as per their convenience. This is not reflected in persistency ratios. So people end up buying products. This brings us to an important point: how insurers currently report persistency figures. Some insurers include group policies that are largely single premium policies and single premium retail policies in their persistency calculation. Including this inflates the persistency reported, as there are one-time payment policies and don't lapse. So reporting persistency on the basis of retail regular premium policies will reflect true customer retention, and that needs to understand right. What is also required at this point is further slicing of this number. It is important to break persistency number by policy type and channel of distribution. The term plans have a retention rate of more than 90%, and even if you lapse, you don't lose anything in them because you are only paying the cost of insurance. Poor persistency is primarily the result of policyholders surrendering or lapsing their policies midway. This behavior is largely caused by poor sales practices followed by the insurance industry. Poor persistency is mainly on account of lapses. So a lapse occurs at the point of sale when a policy is missold or bought with poor understanding. Some of the factors that can be attributed to low persistency are unexpected changes in policyholders' financial position, uncertainty in job market, and failure to pay premiums on time. So even in ULIPs, the exit load is minimal, but it is very high in non-linked plans. There is no motivation to surrender the policy, but the same is not true for traditional plans, where policyholders sometimes prefer to lapse than continue with a plan they don't understand. So persistency ratio need to get cleaner and sharper, as they are a commentary on the selling practices of an insurance company. So when do insurance policy lapse? Lapse policies show market immaturity, where product manufacturers and buyers are still figuring out the right product mix. So poor persistency is primarily the result of policyholders surrendering or lapsing their policies midway. This behavior is largely caused by poor sales practices followed by the insurance industry. Poor persistency is mainly on account of lapses, and a lapse occurs at the point of sale when a policy is missold or bought with poor understanding. Thank you. Thank you very much.